Where have all the IPOs gone? Why companies are staying private and what it means for your wallet. Remember 1996. That year, 739 companies went public in the US. Last year, only about 225. That's a huge drop, and it's not the only concerning trend. 30 years ago, the US boasted over 8,000 publicly traded companies. Today, that number is roughly 4,000. Half. Companies are vanishing from the public markets, and new ones are choosing to stay private for longer, sometimes forever. What's driving this unprecedented shift, and why are economists and regulators so worried about it? Why go public in the first place? The IPO catalyst. To understand the change, let's remember the core purpose of going public. Imagine you're a brilliant entrepreneur who started with car seats, moved into specialized car engines, and now you want to build a whole car manufacturing plant. Your business is booming, but the investment required is massive, far beyond what your friends or even a group of rich private investors can provide. This is the moment for an initial public offering, IPO. An IPO is a company's first sale of stock to the general public. It's how a company transitions from passing the hat among a few wealthy backers to opening the door for everyone to invest. The upside of an IPO: massive capital infusion. Selling shares to the public unlocks pools of money that private fundraising can't match. This influx pays for new factories, major R&D, and huge acquisitions. A clear exit for insiders. It provides founders, early employees, and early investors a path to convert their paper gains into real, spendable cash. Credibility and trust. A public listing, with its required audits, regular disclosures, and visible stock price, builds trust with customers, partners, and top talent. It also allows the company to use its stock as currency for buying other businesses. Stability. Spreading the shareholder base across thousands of investors makes the company less dependent on any single person's checkbook. Going public means trading a bit of control and privacy for the resources and credibility to play on a much bigger stage. The Great Retreat. Why the IPO is going out of style. Despite the massive benefits, the trend is undeniable. The US has fewer public companies than at any time since the 1980s. Companies are waiting longer to IPO, and some, no matter how successful, have decided to stay private indefinitely. Think about it. Uber was founded in 2009, but didn't IPO until 2019, nearly a decade later. Airbnb waited 12 years after its 2008 launch to go public in 2020. Stripe, a payments giant recently valued at over $100 billion, has no immediate plans for an IPO. SpaceX, the world's most valuable private company at over $400 billion, is staying private, with Elon Musk stating an IPO won't happen until they establish a working colony on Mars. This shift is driven by four major forces. 1. The explosion of private money. Decades ago, if a startup needed $100 million for its next growth stage, an IPO was the only realistic option. Today, that's no longer true. There are massive, unprecedented pools of money floating around outside the stock market: venture capital, VC, and private equity, PE. These firms raise billions from wealthy investors and institutions to invest in and grow companies without ever taking them public. Sovereign wealth funds. Giant national investment accounts from countries like Norway or Saudi Arabia pour billions into private companies. In short, founders no longer need to ring the bell on Wall Street to raise the money they require. This has allowed companies to delay their IPO for years. The median age of a company at IPO has jumped from 6 years in 1980 to 11 years today. 2. The high cost of compliance. Following corporate scandals like Enron, Congress introduced new regulations to restore trust in public companies. While these changes improve transparency, they also made being public far more expensive, especially for smaller firms. Maintaining the necessary paperwork, audits, formal board structure, and investor relations can cost a company millions of dollars a year. This intense scrutiny and bureaucracy lead many founders to conclude, if they can raise the money privately, staying private is the simpler, cheaper choice. 3. The pressure of short-termism. Once a company is public, it stops answering only to its customers and starts answering to Wall Street, which runs on a 90-day clock. Quarterly scrutiny. Miss your earnings target by a single penny, and your stock can tank. This volatility is exhausting and can pressure leadership to think in terms of the next 3 months instead of the next 3 years. Sacrificing innovation. A CEO might want to invest heavily in a risky, long-term innovation, but if that investment means missing their quarterly earnings, they're often forced to hold back. Activist investors. Public companies also have to deal with hedge funds that buy up huge stakes and push management to cut costs, spin off divisions, or even sell the company entirely. Staying private allows founders to be more patient and invest for the long term without the constant judgment of the quarterly earnings treadmill. 4. Mergers and acquisitions, M&A. Many companies that might have gone public in the past are simply being bought out before they ever reach that milestone. In the tech world, giants like Google, Apple, and Meta make a habit of scooping up promising startups. This isn't just about gaining new technology, it's about preventing rivals from rising up. Private equity firms also play a massive role, buying and growing companies, keeping them private, and then reselling them years later. For many startup founders, the goal from day one is no longer an IPO. It's getting a big buyout offer from a bigger fish. The hidden cost. Why everyone should care. So, companies are staying private and getting bought out more often. Who cares? Economists and regulators do, because this shift has significant consequences for everyday people. The wealth concentration problem. When companies stay private for longer, regular people miss out on the early, high-growth stages of a business where the biggest investment gains often happen. Instead, those profits go almost entirely to private investors who were already wealthy to begin with. Over time, this means the stock market offers fewer opportunities for everyday people, and more of the wealth created by innovation is concentrated in the hands of a smaller, richer group. Less oversight and more risk. New regulations, while costly, exist for a reason. They protect investors and consumers and help prevent fraud and collapse. When massive companies that affect millions of lives remain private, they don't face the same level of oversight. Problems can stay hidden until it's too late, as was the case with the infamous FTX. Eroding competition and innovation. The rise of M&A means that fewer companies are growing into competitors. When big players absorb every innovative challenger, you end up with less competition, less innovation, and more power concentrated in a handful of giants. That might be great for the corporate titans, but it leaves consumers with fewer choices and potentially higher prices. What happens next? IPOs aren't extinct, but they've certainly changed. The US still has the world's deepest capital markets, but companies are tapping into them differently. For decades, going public was the way a company got big. Today, most companies only go public once they're already big. This transformation is reshaping the corporate world and the way we invest in it. The question for you is this: is this a good thing or a bad thing for the economy? Will the IPO make a comeback, or are we just seeing the new normal for corporate growth? Let us know what you think in the comments below.